Have any of you ever wondered about making a whole lot of money really fast and then suddenly not having that money anymore? Well, if you have, today I'm going to be talking about some of the most significant frauds, scandals, and crises that have happened in the financial sector. Bernie Madoff is probably the biggest and best known of these stories. His financial adventure begins in the 1960s when he starts a penny stock brokerage, which eventually, over the decades, develops into a very large fund and market making business. In the 80s and 90s, he's one of the largest market makers and sometimes the largest market maker in US markets. And while he's running this very successful market making business, he's also managing funds, which have rather unusual returns. He has very reliable returns of around 1 to 2% every month that don't seem to change much at all, ever, in any market condition. And by 1999, Boston-based forensic accountant Harry Markopolos notices. These returns aren't only very unusual, they appear to be mathematically impossible, particularly in light of the strategy that Madoff claimed to be using. He claimed that he achieved such steady, reliable returns by using split strike conversion, which is more commonly referred to as a long collar. It's constructed by buying a position in an equity or an equity fund, then selling long out-of-the-money calls with one call option for every 100 shares owned, and then using that money from the short call position to buy an equal number of out-of-the-money put options, with the idea that the puts provide downside protection and are being paid for by the short call position. And his returns were not consistent with that strategy. Now, Harry Markopolos did contact the SEC about Madoff, but nothing was done. However, at that time, it wasn't as though Madoff was entirely ignored. There were growing suspicions across the financial sector. Many investors were suspicious of the returns and just didn't invest with him. And by the early 2000s, Renaissance Technologies, perhaps the most successful hedge fund ever, had pulled out 50% of their position in Madoff funds. But he was still a large market maker, he was still very politically connected, he was very significant on Wall Street, and he still had a lot of client money invested. And in reality, all he was really doing was just not investing the money. He'd take their money, keep it, then just give them fake return numbers. And he achieved this through a Ponzi scheme named for the early 20th century legendary swindler, Charles Ponzi. So say you want to start one of these. You go to potential investors and say you have some great idea for a fund that's going to make a huge amount of money. And the initial investors give you some money to invest. Now you don't invest it all. You just give them a sheet of paper that says you made a bunch of money. And hopefully, they think you're really good at it and don't ask for their money back. So then this starts attracting new investors, seeing those really great returns that you're supposedly getting. And now they give you money to invest. And this keeps going and you get more investors. But what if some investors want their money back at some point? Well, you take from that large pool some of the money you were given, and you give that back to those investors. As long as too many people don't ask at once, you can give some of it back, and just keep up the appearance that you actually have all that money made. So then more come in, and you pay back earlier investors with the new money that came in. Then more come in and you give that money back to people who are trying to get their money out. And you just keep doing this. You keep some money on hand from the new investors to pay back the old investors and try to pocket as much of it as you can. And this just keeps going and going until, well, you hope it keeps going. There's theoretically no specific end, but it probably is going to fail at some point, so you just sort of hope it keeps going. Until we get to 2008, after the Bear Stearns and Lehman collapse, where investors are starting to become a whole lot less confident, and a lot more are starting to ask to get their money back. So he tries to hold investors back to keep as many of them as possible from trying to withdraw their money. And in the meantime, he is asking everyone he knows for money. He's created just this one big loop of money that's now spinning faster and faster as he needs to keep asking for more and more, while more and more people keep trying to get back their money that doesn't exist. And by December 4th of 2008, he said to his CFO, Frank DePascali, "We're finished." By December 10th, he tells his sons about what he's been doing, and he hopes to have about a week or so to be able to take care of things before going to law enforcement. But his sons get lawyers, and on their advice, they get in contact with prosecutors in the SEC, and it is now all out there. His sons recount that he explained it as it was all one big lie. He ends up being sentenced to a 150-year prison term and is ordered to pay $170 billion in restitution, but the money that he defrauded from investors has not even come close to being repaid. Raj Rajaratnam and the Galleon Group. Raj Rajaratnam ran the Galleon Group, a very successful New York hedge fund. Our story begins with John Moon, a UBS lawyer who finds what is suspected to be friends and family violations on the part of an investment fund run by Rangan Rajaratnam. The suspected violation is that the fund is allocating the winning trades to preferred clients, friends, family, clients they really particularly want to please, and allocating losing trades to other clients. Now, Rangan is the brother of Raj, and as the SEC starts digging further into this, they start to find quite a lot more popping up. They begin to become very suspicious of Raj. The FBI ends up finding a Silicon Valley insider who once worked at IBM, who they believe has been supplying him with insider information to trade on. Armed with growing evidence, the FBI is able to turn her into an informant, and the investigation begins to really pick up. What is suspected is that Raj Rajaratnam and his hedge fund have been trading on insider information. Specifically, the technical, legal, and industry standard term is material non-public information. Material non-public information is any information about a company that has not been publicly disclosed, and if it were known, would have an impact on the share price of the company. This could be something like knowing the results of a clinical pharmaceutical trial before those results have been published. And the law is that anyone who has that information cannot trade securities on it. Author of the book The Buy Side, Turney Duff, recounts a time when he was working at the Galleon Group and was left to man the phones when the company received a call. In rushed and hushed tones, the call says that Jeffries will be upgrading their rating on Amazon in 6 minutes. Left with only 6 minutes and unsure of what to do, he buys the Amazon shares. The FBI and SEC continue to investigate, eventually being able to flip Galleon trader David Slane, who gives significant information on Raj. What is discovered is that there is a large network of people that the Galleon Group has pulled together over the years who have information in various different sectors, who are able to feed them information that the firm can then trade on. And it turns out that it was a very large web of other funds, industry executives, specialized experts in different fields, all the way down to low-level employees in companies that the firm is interested in trading on. Armed with all of this evidence, the FBI is able to get authorization to begin using wiretaps on Galleon traders, portfolio managers, and Raj. The most major wiretap recording occurs after Rajat Gupta, a major Wall Street and corporate figure who was sitting on many boards at the time, including Goldman Sachs, learns of Warren Buffett's planned investment into the company. Now, Warren Buffett sending a bunch of money your way is just about one of the biggest bits of news that there could possibly be in Wall Street. And Rajat immediately told Raj Rajaratnam all about it. With all this information and evidence of a network of insiders, Raj Rajaratnam is convicted on 14 counts of conspiracy and securities fraud. This case has since had a major impact, significantly changing how financial firms and the SEC deal with insider trading. SAC Capital. SAC was started by Steve Cohen, who began his career as a trader at Gruntle, and early on, he's noticed as being an excellent trader who seems to have just an intuitive understanding of what the market is going to do. After a time of being a very successful trader, Steve leaves Gruntle and starts SAC, which has incredible returns. But with them, they're also very high fees. Now, these fees were just truly enormous. SAC was getting a 3% management fee and 50% of returns. But when they were getting 60+% returns, and after fees, it's still around 30% returns for the investor. It's an incredible return. However, suspicion eventually arose and SAC was wiretapped as an investigation began into the firm. What the investigation finds is that a very large network of insiders and experts are giving information to SAC, some of which could fall under insider trading. As a result of the investigation, in 2011, 2 former employees of SAC are charged with insider trading. In 2013, SAC portfolio manager Michael Steinberg is arrested for insider trading. In court, he ends up receiving a 3.5-year sentence and a $2 million fine. Ultimately, after appeals and the Supreme Court declining to review, the conviction ends up being dismissed. In 2013, SAC is charged with conspiracy and securities fraud. Initially, a total of 8 former employees are cited, and by the end, 8 had either pled or were convicted. 2 were dropped, and 1 vacated plea. In July of 2013, the SEC files a civil suit for failure to supervise traders. This results in a guilty plea, and so in the end, SAC was no longer able to manage outside funds, was given a $1.2 billion fine, and altogether, across all penalties, they ended up with a $1.8 billion fine. Long-term capital management. The case of LTCM is not one of fraud or a scam. It's nothing criminal nor nefarious at all, but it serves much more as a cautionary tale about knowing the risks you're getting yourself into. LTCM is started in 1994 by Jim Merriweather, and it has very impressive people associated with it. Among them, it has on its board Myron Scholes and Robert Merton from the BSM model that we've seen in the options videos. So its people, its idea for an investment strategy, it all is very impressive at the beginning. Now, they're able to get very high returns in the beginning. However, their strategy requires a lot of leverage, and there is a lot of volatility to it. They use different approaches in their strategy, but among them, very significantly, is statistical arbitrage. Statistical arbitrage has become an increasingly popular investment strategy, but at the time of LTCM, during this quant boom, where increasingly there were more and more quantitative hedge funds, it really began to expand in use rapidly. The idea behind statistical arbitrage is, say you have 2 different assets, A and B, that tend to trade together, or very close to each other, or at a very reliable ratio. Either 2 things that are very similar, or have some relationship to each other that will bound where each other trades. The idea is that if you see them diverge from their normal relationship, the one that is relatively higher in price than where the relationship expects it to be, you go short on that, and the one that is relatively low in price from where it's expected to be, go long on that. Then profit from their movement as they converge back to where they're expected to be in the relationship. Now, even though you're long one and short the other, it doesn't matter if they both move up or both move down to get back to that relationship, since that overall combined movement of the 2, since you have a position on both sides, you are getting the profit from their coming back together and not from the actual movement up or down of the pair as a whole. However, in 1997, a series of currency devaluations, which have since become known as the Asian financial crisis or Asian contagion, occurs, and in 1998, a bond crisis in Russia occurs as well. Unfortunately for LTCM, they're exposed to it, and in August 1998, they lose $1.85 billion. Now, unfortunately for LTCM, their positions are so levered that when they start taking losses, they have to sell positions that they believe could be profitable at a loss just to cover those losses, which creates just a spiral of loss after loss after loss for the company. In September of 1998, they began with a total of $2.3 billion under management, and by the end of the month, they have $400 million. They have taken over 80% in losses in just 1 month. Seeing the sheer catastrophic losses going on in the company, a consortium of financial firms come together to offer a deal to bail out and buy out the firm. The companies involved in this are Goldman Sachs, Berkshire Hathaway, and AIG. Unfortunately, the offer that they give is viewed as too low by long-term capital management, and no deal was able to be reached. However, this just escalates and gets the attention of the Federal Reserve Bank of New York, who wants a bailout to avoid contagion. So they pull together a deal, raising money from various financial firms. Altogether, these firms raise $525 million. Now, for long-term capital management, this comes with a pretty steep cost, as the ownership are only going to be able to keep 10%, while that group of financial firms will take 90% ownership of the firm. In the end, when it's all done, the firms had suffered $4.6 billion in total losses. The partners only have 10% ownership at the end of around $400 million, and this could sound like a good chunk of equity, but the partners originally began by putting $1.9 billion of their own money into it. So for them, it's just a gigantic loss. The thing that makes LTCM really interesting is that it was a very clever strategy. They were very smart people. The problem with it is that they took on enormous risk and levered that risk up so high that while most of the time they'd be able to make a good profit, a left tail event could just wipe them out, and they didn't give adequate attention to the possibility of anything like that happening. So it's a good example of both something that looks impossibly good to be true, there's probably a hidden downside or hidden risk somewhere, and also on the topic of risk, how important it is to be aware of what your risks are. Bayou Hedge Fund Group. So Bayou is just nuts. We've seen examples of frauds and scams before, but this one is it's just ridiculous. So the company is founded by Sam Israel, and in their first month, they immediately do badly. But you wouldn't want to say that, right? So what if you just said you're doing well? So they put out fake returns. And not only did they put out fake returns, but they fake audit themselves with a fake accounting firm that they set up to audit the fake returns. What's nuts is that, by all accounts, it looks like they actually did set out to run a genuine hedge fund in the beginning. But right off the bat, they immediately lose money and just decide, they'll just say it's fine. So they just keep this going until 2004. They just keep making up numbers and hoping it works. In 2004, they attempt to withdraw funds, and people start taking notice of that. And in 2005, an investor in the fund wants to redeem. So the fund sends them a check, and the check bounces. Curious as to what could be going on, the investor goes to the fund office and finds it completely empty with only a note on the desk that just says it was all fake. They just kept losing money, then kept trying to make money to cover the losses, but they just kept losing money and kept putting out numbers saying they're doing well, all while running a fake accounting firm. It was actually incredible it lasted that long. In 2008, founder Sam Israel ends up sentenced to 20 years and is given $300 million in forfeiture. So looked like he was going to turn himself into the prison, looks like it was all going to be resolved, but no one can find him. They find his car by Bear Mountain Bridge in New York, and after an extensive manhunt, they figure he had died and was somewhere in the middle of the woods. Ultimately, the fund goes bankrupt, and it has since completely ended. Last I have Charles Ponzi. I was trying to figure what I should include in this video, and I will be making more videos on this topic, but I wanted to start with the only guy that one of these scams has actually been named after. Despite the scale of the Bernie Madoff story, no one calls it a Madoff scheme. Charles Ponzi was born in 1882 in Emilia-Romagna in the new and short-lived Kingdom of Italy. He originally comes to the United States in 1903 and shortly after worked in a Quebec bank after moving to Canada. It's in Quebec working at this bank, which has really Ponzi-like lending strategies, where he first picks up the idea for that sort of scheme. However, the bank ultimately goes bankrupt, and after being convicted of check fraud, he is imprisoned. Well, he returns to the United States and then starts working with Italians who are involved in smuggling people from Italy into the United States, for which he is caught, convicted, and sent back to prison. After leaving prison, he lives in Boston where he does a series of different odd jobs, including trying to save a failing fruit company, ultimately to no avail. He ends up setting up an office in Boston trying to sell business ideas when he comes up with his plan. What's the plan? Postal reply coupon arbitrage. It's foolproof. Double your money in 90 days. It's great. We'll make so much money. So you can buy a postal reply coupon in country A, send postage overseas, and that coupon covers the payment of the return mail. However, it can also be exchanged for reply postage in the other country. So if there's a differential in price between the two countries, then that differential means profit. Foolproof. I just need a lot of money. So people gave him that lots of money. And it grew. And it grew. At first he was getting genuinely good returns, but it just got so huge that he just started making it up after a while. And it got bigger, and he had a more and more lavish lifestyle, and it got bigger. And eventually some problems were noticeable. For example, there weren't that many postal reply coupons in the world for him to actually be doing it with this much money. So people started asking questions, started digging into him. At first, when a group of very nervous investors came to his office to try to redeem their money, he came out and handed out money and made a grand show of how much money he had. But people kept looking. It was just clearly impossible what he was claiming to do. So eventually he gets caught. A newspaper fully exposes exactly what he did and is arrested, tried, and convicted. Now after that, he has more adventures in scamming, including more scams in more places, getting arrested more, getting tried and convicted more, and fleeing more, until eventually the government gets completely tired of it and sends him back to Italy. Oh, also he did keep doing more scams there as well. Well, I hope you enjoyed this. I'm going to cover more stories like this again in the future as well, so do subscribe if you're interested. So until then, have a fine time.